Normally, diagnosing a broken economy is, kind of like diagnosing a broken arm.
Right.
You take an X-ray, you find the jagged white line where the bone snapped, you point to it, and you put a cast on it. It's clean, it's visible, and it's comforting to know exactly what's wrong. But today we're looking at an economic landscape where the X-ray isn't just murky. It's showing us an entirely new anatomy.
Yeah. We are looking at a system that is actively mutating in real time. I mean, the old rules of cause and effect simply are not applying anymore.
Which brings us to today. Today is June 16th, 2026. Welcome to the Deep Dive, everyone. We are unpacking a massive stack of news that all hit the wire at the exact same time.
Right, within the same 24-hour window.
Exactly. We're looking at a historic Middle East peace deal aimed at unblocking the globe's most critical maritime choke point. We're watching central banks completely rewrite the rule book on global interest rates.
Yep.
There is a sudden, just brutal crash wiping out big tech stocks. And right in the middle of all this, Elon Musk's SpaceX drops $60 billion to buy an AI company. So, okay, let's unpack this.
It's a stunning convergence of data, honestly, and it requires us to completely reevaluate the relationship between the physical supply chains that, keep the lights on and the digital networks that run the world.
The mission today is to show you how these seemingly disconnected events are actually deeply intertwined. We are exiting an era of acute geopolitical and inflationary crisis and entering what experts are calling the Great Realignment.
The Great Realignment, yeah.
And to guide us through this, we're pulling from a huge stack of sources today. We've got breaking news from CBS and the Straits Times, macroeconomic analysis from the Conference Board, some press releases from major chemical companies, and tech market breakdowns from Kavut and the Motley Fool.
And the through line connecting all of these reports is just unmistakable once we start peeling back the layers.
So let's start with the catalyst, the geopolitical pivot that is arguably driving everything else today. We've got this Swiss-brokered memorandum of understanding between the U.S. and Iran.
The Bergenstock Accord.
Right, the Bergenstock Accord. And the whole point of this is to de-escalate the conflict that has blocked the Strait of Hormuz since, February 28th?
Yeah, late February. And the sheer scale of this maritime bottleneck is staggering. I mean, we are talking about the most critical energy artery on the planet.
Right.
Since the blockade essentially began, we've had 1,000 commercial vessels and something like 20,000 seafarers just stranded.
Wait, 20,000 people just stuck out there?
Just stranded within the Arabian Gulf.
Yeah.
These massive container ships and oil tankers have literally been trapped in a high-threat zone.
Yeah.
The impact on global energy throughput is, well, it's severe.
I can imagine.
Before this conflict escalated, crude oil moving through the strait was averaging roughly 20 million barrels a day during the height of the crisis. That throughput collapsed to a mere 8 million barrels a day.
Wow. Which, that explains why the markets reacted so violently to the news of this deal. Just the announcement that a piece of paper had been signed in Switzerland sent shockwaves through the commodity sector.
Oh, absolutely.
Brent crude plunged nearly 5% in a matter of hours, dropping back below $80 a barrel for the first time since early March.
Right, because the market is instantly pricing out that massive geopolitical risk premium. But you have to remember, the market is trading on the headline.
Right.
The physical reality of reopening that waterway is vastly more complicated than a diplomatic photo op.
And that's what I want to dig into, because signing a treaty doesn't magically teleport 1,000 stranded ships to their destinations. I was looking at the CBS reporting, and they're saying it's kind of like trying to clear a massive multi-car pileup on the world's busiest highway. But the highway is also covered in maritime mines.
Exactly. The insurance aspect alone is a nightmare. The marine war risk premiums have skyrocketed. It's financially ruinous to move a hull through that water without absolute certainty of safety. And that certainty just does not exist yet.
So how many ships are actually getting through right now?
As of Monday and Tuesday of this week, maritime monitors are tracking maybe 4 or 5 ships a day attempting the crossing.
4 or 5 a day, compared to the normal 138.
Yeah, 4 or 5 is essentially a statistical zero, which leads the IEA to project that returning to baseline energy throughput will take months. And that's assuming everything goes perfectly.
And spoiler alert, things are not going perfectly.
No, not at all.
Because as a neutral observer, looking at these statements coming out of Washington and Tehran and Jerusalem, it's baffling. It's like these three governments read entirely different documents. Let's lay out these discrepancies for you listening, because the cracks in this accord are wide open, starting with the transit tolls.
Right, the tolls. We have President Trump on the record stating unequivocally that the strait will be, quote, permanently toll-free. He's framing the U.S. as the ultimate guarantor of regional security.
Okay.
But the Iranians are saying something completely different. The Fars news agency released statements indicating that service fees for maritime transit could absolutely be imposed after a 60-day window.
Wait, so Trump says it's free, and Iran says they're putting up a toll booth in 2 months.
Basically, yeah. And it gets even more contradictory when we look at the financial side of things. Iran's Revolutionary Guard, the IRGC, published this 14-point list claiming half of their $24 billion in frozen funds will be released before final negotiations. They're also demanding a $300 billion post-war reconstruction fund.
$300 billion. The U.S. isn't agreeing to that, right?
Categorically denying it. U.S. officials are stating 0 assets have been released. They're maintaining that any sanctions relief requires strict compliance with nuclear nonproliferation.
So they're miles apart on the money. What about the actual fighting?
That's the most dangerous discrepancy. The deal theoretically includes a cessation of hostilities in Lebanon, but Israeli officials, including Prime Minister Netanyahu and Defense Minister Katz, explicitly state they are not bound by this.
Whoa.
Yeah. They've said they will remain in Lebanon indefinitely to dismantle Hezbollah infrastructure.
So why does this matter to you, listening to this right now? Because that geopolitical risk premium is baked into the price of literally everything you buy, from gas to groceries.
Yeah.
But here's the catch. Normally, dropping oil prices would mean central banks could relax, right? They'd see inflation cooling and start cutting interest rates.
Right, normally.
But this time, they are doing the exact opposite. Which brings us to the new Federal Reserve regime under Chairman Kevin Warsh.
Yeah, the Warsh Fed, the FOMC, is meeting today, and they are expected to completely abandon the easing bias of the past 2 decades. They're shifting to this regime of monetary structuralism.
Okay, monetary structuralism, explain that for us.
It basically means they are prioritizing hard price stability over market liquidity. They aren't going to rush in to save the stock market with cheap money every time there's a hiccup. Traders have already slashed their expectations for a 2026 rate cut down to 57%. And the dot plot will likely show 0 cuts for the rest of the year. The Fed is holding rates at 3.5 to 3.75%, but the real tightening is happening via balance sheet reduction.
Quantitative tightening.
Yes. $5 billion a month for treasuries, $35 billion for mortgage-backed securities. Just vacuuming money out of the system.
But the U.S. Fed isn't even the biggest monetary shockwave today. We have to talk about the massive news out of Tokyo. The Bank of Japan just raised rates to 1%.
Which is a 31-year high for them, taking borrowing costs to levels unseen since 1995. This marks the definitive end of Japanese exceptionalism and the era of global negative interest rates.
It's the end of the giant free money ATM.
Exactly. If we connect this to the bigger picture, you have to ask why the BOJ did this. Despite the Iran peace deal driving oil down, wholesale inflation in Japan spiked to 6.3% in May.
6.3% wholesale.
Yeah. A weak yen and high imported fuel costs forced their hand. The vote to hike was 7-1, which shows they are way more scared of inflation than a growth slowdown.
But if oil prices are dropping today, why are central banks locking in these high rates now? Aren't they fighting yesterday's war?
It's a fair question, but the inflation pass-through in business-to-business transactions is just happening too fast. Central banks are prioritizing that hard price stability. They can't afford to let inflation get structurally embedded.
So the era of cheap money is dead. And when the fundamental cost of money changes, the stock market reacts violently. Which brings us to the industrial peace dividend. We saw a wild divergence in the market today. The Dow Jones shot up over 400 points to a record high of nearly 52,000, while the Nasdaq actually fell 1.5%.
A textbook sector rotation.
The winners were the cyclical companies, right? Caterpillar, Home Depot, JP Morgan.
Yeah, those companies surged. And why? Because cheaper energy and a stabilized geopolitical map help companies that build physical things. We also saw Roku get bought by Fox for $22 billion.
Right. But to prove how physical industries are adapting to this high-rate environment, let's look at the M&A strategy with Olin and Huntsman.
Oh, this is a fascinating deal.
A $12.5 billion merger of equals between these two chemical giants. Break down the rationale here.
It's all about vertical integration. Olin makes the upstream raw materials, like chlorine and caustic soda. Huntsman makes the downstream products, like polyurethane and advanced materials. By merging, they expect $400 million in annual synergies.
It's like a lumber yard merging with a custom furniture maker. By controlling the whole process from the raw tree to the dining table, you protect yourself from supply chain shocks. You don't have to worry about the guy you buy the wood from suddenly doubling his prices.
Precisely. They're constructing a closed-loop supply chain to survive a high-rate, low-growth cycle.
So while the physical economy is consolidating to survive, the digital economy, specifically the AI sector, is suddenly facing a massive reality check. Let's talk about the tech correction and the hidden memory chip crisis.
The bloodbath in semiconductors today.
Yeah, Broadcom dropped 14%, and that dragged down NVIDIA, AMD, Micron, and Intel.
And the trigger for this was Broadcom's earnings report. They actually beat earnings expectations, but they issued cautious Q3 AI chip sales guidance of $16 billion.
Which missed the $17.2 billion estimate.
Right, and they didn't raise their full-year forecast. In a market priced for perfection, that sparked a massive sell-the-news event.
But here's where it gets really interesting. It's not just about AI hype cooling. It's a physical bottleneck. Global smartphone demand is projected to collapse 13% in 2026. That's the biggest drop on record.
It's a tsunami-like shock, and it's driven by the memory chip crisis. It's a zero-sum game right now. Companies like Micron are diverting all their manufacturing capacity to high-function AI data center chips, which means they are literally starving the consumer electronics market. Deloitte predicts a 50% price spike for essential memory components.
30%. So if you're Apple or Samsung, your costs just exploded.
Exactly.
So are we looking at an AI bubble bursting or just buyer exhaustion?
It's buyer exhaustion mixed with extreme valuation anxiety. Look at Intel trading at 904 times trailing earnings. The overall AI market is still projected to hit $975 billion, but the easy money phase is definitively over.
But there's one exception to this tech slump. One company that completely defied the NASDAQ drop today. SpaceX.
Yeah.
After a record-breaking $85.7 billion IPO in February, SpaceX stock is up 40%. They're valued at over $2 trillion. And today, they just bought the AI startup Cursor for $60 billion in common stock.
It's a massive move. And to understand why, we have to look at the next frontier, agentic sovereignty.
Right, because Cursor isn't just another ChatGPT.
No, generative AI versus agentic AI is a huge distinction. Cursor doesn't just generate text like a chatbot. It uses agentic AI. It can autonomously execute code, debug, and make software architecture decisions without human prompting.
Generative AI is like having a really smart intern who can draft an email for you. But agentic AI is like having a senior engineer who not only writes the software but fixes the bugs and deploys it while you sleep.
That's a perfect analogy. And SpaceX's long game here is incredible. They aren't just a rocket or satellite company. They estimate their total addressable market is $28.5 trillion.
Trillion with a T.
With a T. And 26.5 trillion of that is coming from AI. By vertically integrating Cursor with their Colossus XAI compute infrastructure and the Grok model, they are building autonomous systems capable of running orbital data centers.
Okay, but to build this agentic AI future, you need hardware. You need physical chips and energy. And hardware relies on a global trade network that is currently fraying at the seams. Which brings us to global trade friction.
The G7 hot mic incident.
Oh man, this was wild. Canadian Prime Minister Mark Carney was caught on a hot mic telling President Trump about a side deal Canada made with China. Break down the details of this EV compromise.
Well, Canada agreed to allow 49,000 Chinese EVs into their market at a low 6.1% tariff.
Which is a huge drop from the previous 100% tariff.
Massive drop. And in exchange, China removed tariffs on Canadian canola. Now, Trump's recorded reaction was positive. He said, that's good, I like that.
Right.
But U.S. trade officials are absolutely furious. They are warning this threatens the North American Free Trade Agreement, CUSMA, which is up for renewal on July 1st, because the U.S. remains fiercely committed to its 100% tariffs on Chinese EVs.
They're worried those cheap EVs are going to flood across the border.
Exactly. And this raises an important question about how different regions are surviving this realignment. We are seeing a diverging global economy. Look at China. It's a two-track economy right now. Industrial tech output like 3D printing and robotics is soaring, but domestic retail sales are crashing due to a massive real estate bust.
So they have to export to survive.
Right. Meanwhile, in the U.S., the stock market is high, but the real economy is cooling. Housing starts are at a 6-year low, and services are contracting.
In Europe.
Europe is enjoying a brief relief rally from the Iran deal lowering energy costs, but the ECB and Lagarde remain highly, highly cautious.
So, synthesizing this whole journey we've been on today, we've gone from the clearing of the Strait of Hormuz to central banks locking in high rates, to old-school chemical companies merging to survive, to the sudden evolution of AI from chatbots to autonomous software agents.
It's the great realignment in action.
Give us a final thought to mull over as we wrap up.
Well, think about this. We are entering a world where the physical economy, energy, chemicals, hardware is becoming vastly more expensive and consolidated, just as the digital economy becomes fully autonomous. The most successful companies of the next decade won't be the ones who just use AI. They'll be the ones who own the physical infrastructure to power it and the agentic software to run it without human intervention. So the question is, where do you fit into that supply chain?
That is a fascinating question. Are you the raw material, the software, or the middleman getting engineered out?
Exactly.
All right, thank you for joining us on this deep dive into the sources. Keep questioning how reliant your own industry is on both global supply chains and emerging AI. We'll see you next time.